Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Tandem Diabetes Care Inc. Annual Report. Tandem Diabetes Care Inc. offers a range of technology solutions for people living with diabetes worldwide. The company's flagship products include the Slim X2 insulin delivery system and Tandem Mobile Insulin Pump, an automated insulin delivery system. In addition to these flagship products, Tandem Diabetes Care provides various single-use products, such as cartridges for storing and delivering insulin, and infusion sets that connect the insulin pump to the user's body. The company also offers software solutions, including the Tandem Device Updater, which updates the pump software from a personal computer. Furthermore, Tandem Diabetes Care provides data management platforms like Tandem Source, a web-based platform that displays diabetes therapy management data from pumps and integrated continuous glucose monitors, CGMs. Additionally, the company offers mobile apps such as SugarMate, which helps people visualize their diabetes therapy data. The company has also partnered with the University of Virginia Center for Diabetes Technology to research and develop fully automated closed-loop insulin delivery systems. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what may cause a stock price to drop. The stock price of any company can fluctuate due to various reasons. One major factor is poor financial performance, such as declining revenue or increasing losses. This can be caused by internal issues like inefficient management, lack of innovation, or failure to adapt to changing market conditions. External factors such as economic downturns, industry disruptions, or regulatory changes can also negatively impact a company's stock price. Another reason for a decline in stock price is negative news and publicity. If a company faces scandals, product recalls, or other controversies, it can lead to a loss of investor confidence and a subsequent drop in stock value. Additionally, if a company fails to meet analyst expectations or experiences delays in product launches, it can also contribute to a decrease in stock price. In the case of Tandem Diabetes Care Inc., without access to specific information, it is difficult to pinpoint the exact reasons for its declining stock price over the past year. However, it is likely that a combination of these factors has contributed to the decline. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be attributed to several key factors. On the growth side, increased volumes, improved average selling prices, favorable changes in foreign currency exchange rates, and reduced non-manufacturing costs have all contributed to revenue expansion. Specifically, pump sales and supplies sold have seen significant increases, with pump sales rising by 27% from 2023 to 2025. In contrast, the primary drivers of revenue decline are related to decreases in total inventories, increases in depreciation and amortization expense, and intangible asset write-off/amortization. These factors may indicate a decline in sales or revenue, as well as decreased profitability. It is worth noting that while international revenue has seen significant growth, with a 60% increase from 2023 to 2025, the overall trend of revenue growth is driven by changes in domestic and international sales volumes, average selling prices, and foreign currency exchange rates. In summary, understanding these key drivers is crucial for businesses looking to optimize their revenue growth strategies. By identifying areas where they can improve sales volumes, pricing, and cost management, companies can make informed decisions to drive revenue expansion or mitigate decline. The net income of the company experienced a significant decline between 2023 and 2025. In 2023, the company reported a net loss of -$91.9 million, which increased to -$200.3 million in 2025. This represents a decrease of $108.7 million from 2024 to 2025. The negative impact on net income can be attributed to various factors, including the introduction of GLP-1 class of drugs in diabetes and obesity, increased competition, aggressive pricing strategies by competitors, and potential market confusion. In contrast, the gross profit margin percentage showed an increase from 52% to 54% in 2025 compared to 2024. This indicates that despite the decline in net income, the company was able to maintain a higher gross profit margin. However, the operating profit margin decreased due to increased operating expenses in 2025. The reasons for these changes are multifaceted and complex. Increased competition from similar products with similar features, regulatory risks, and potential product liability claims have all contributed to the decline in net income. Additionally, the company's difficulty in reducing per-unit costs due to low production volumes has also had a negative impact on profitability. Overall, the company faces significant challenges in maintaining its financial performance amidst increased competition and market pressures. The financial performance of a company can be a crucial indicator of its overall health and stability. In this case, the data suggests that the company is experiencing difficulties in generating positive operating cash flow. The numbers presented on pages 66, 79, and 95 all point to a negative operating cash flow for the year ended December 31, 2025. The figures show a significant deficit in operating activities, with a net loss of $9,721 reported on page 66. This trend continues into the following years, as indicated by the -$9,721 figure on page 79 and the -$20.2 million operating cash flow on page 95. These statistics collectively confirm that the company is struggling to generate sufficient cash from its core operations. The negative operating cash flow raises concerns about the company's ability to meet its financial obligations and invest in growth initiatives. It may be a sign of underlying issues, such as inefficient management, high operational costs, or declining revenue. To address this challenge, the company may need to reassess its business strategies, optimize its operations, or explore alternative funding sources. The company's debt level has undergone significant changes in recent years. Initially, it increased significantly, with the issuance of $316.3 million aggregate principal amount of 1.5% convertible senior notes due 2029. However, this trend was reversed as the debt level decreased from $446,882,000 in 2024 to $324,979,000 in 2025. Furthermore, a more recent snapshot shows that the debt level continued to decrease by $38,900 from December 31, 2024 to December 31, 2025. In terms of interest expenses, there is some inconsistency across different pages. However, the most reliable information suggests that interest expenses decreased by -8% from 2024 to 2025. This decline in interest expenses indicates a reduction in the company's financial burden related to debt servicing. The performance of various segments and regions in the market can be observed through several key points. On a global scale, the insulin therapy market, international markets, and type 2 diabetes customers experienced poor performance, as indicated on page 23. In contrast, some regions showed significant improvement. The United States stood out for its strong performance, with increasing sales from $554.9 million in 2023 to $706.9 million in 2025. This growth is a notable trend that highlights the country's resilience and demand for insulin therapy products. Internationally, there was also an increase in sales, rising from $192.8 million in 2023 to $307.8 million in 2025. While this growth is substantial, it lags behind the United States' performance. Europe and Canada, however, experienced poor performance due to foreign currency rate fluctuations, as mentioned on page 70. Overall, these findings suggest that while some regions struggled with market fluctuations, others demonstrated significant growth and potential for future expansion. The company's outlook is one of expansion and growth, with a focus on increasing access and affordability through innovative strategies such as the pay-as-you-go pharmacy benefit model. This approach is expected to drive long-term benefits despite initial short-term impacts on sales and gross profit. Management is emphasizing flexibility and choice in intelligent insulin delivery systems, while also investing in digital technology solutions to enhance scalability and expansion into new markets. The company's commercial investments in sales infrastructure are aimed at driving growth in key regions such as the US and Europe. In terms of operational efficiency, management is implementing various initiatives to create future efficiencies in operations. Additionally, the company is prioritizing cash and liquidity management, relying primarily on product sales to fund its material cash requirements. However, despite these efforts, the company faces several challenges and uncertainties, including regulatory uncertainty, competition from new products and technologies, and potential risks associated with acquisitions and investments. Employee retention and recruitment may also be a challenge due to intense competition and labor shortages. The company's strategic moves have been marked by a single significant acquisition. This move was made with Capillary Biomedical, Inc., which is highlighted in the financial reports on page 68. The acquisition of Capillary Biomedical, Inc. demonstrates the company's focus on expanding its capabilities and resources through targeted investments. The company's financial strategy is centered around retaining its earnings rather than distributing them to shareholders. As stated in their financial reports, they have not paid any cash dividends on common stock and do not plan to do so in the foreseeable future. Furthermore, they have also chosen not to repurchase any shares of their equity securities. This approach suggests that the company is prioritizing internal growth and investment over shareholder returns through dividend payments or share buybacks. The company's supply chain is vulnerable to disruptions due to its dependence on a limited number of third-party suppliers. This exposes the company to risks such as availability, quality, delivery schedules, and potential for suppliers ceasing to provide components. Furthermore, difficulty obtaining components from suppliers acceptable to regulatory authorities could lead to product recalls and delays. The company's manufacturing or distribution processes can be interrupted due to various reasons, including international trade policies that may adversely affect the business, financial condition, and operating results. Additionally, concerns about supply chain disruption have been raised due to increased frequency and severity of supply chain attacks and compromised infrastructure belonging to third parties in the supply chain. However, it appears that the company has made efforts to manage its inventory levels, as evidenced by a decrease in raw materials, work in process, and finished goods inventories from 2024 to 2025. Nevertheless, there are still concerns about inventory buildup due to the risk of overestimating customer demand, which can result in higher inventory carrying costs and excess/obsolete inventory. That concludes the financial summary for Tandem Diabetes Care Inc. Feel free to comment below, and I will be happy to answer them when possible.